Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Brian Joyce, managing director on Nasdaq's market intelligence desk. And Brian, it seems as if we're seeing that shift out of value and commodities and moving back more into the tech names, and you can see that in the relative outperformance in the Nasdaq 100 as of late.
Yeah, as of late, absolutely. We spoke about that last week. This month, Nasdaq had been outperforming, its peers, the S&P 500, and as you just noted, value took a back seat and growth began to rebound again as well. So I think it's near term, just some gyrations. For the most part of this year, growth's been largely underperforming. We've had a lot of information out this week. We had disappointing economic data. So this week we are seeing just some choppiness back and filling. CPI missed much worse than expected yesterday or today. We had the PPI as well. So now the markets are now expecting closer to about 80% probability of the Fed hiking rates 100 basis points. We had the Bank of Canada hike 100 basis points a day or two ago when the market was priced in only 75 basis points. So increasingly hawkish Fed, leading to greater volatility.
And so, Brian, let's take a look at your first couple of charts here, the Nasdaq 100 on a 30-minute and also a daily to establish some fresh technical levels.
Yeah, we've been harping in on this 30-minute time period the last couple of weeks because it's really been important. Just over a month ago on Friday, June 10th, we had the CPI data and the consumer sentiment data come out. They were much worse than expected, similar to this week with the CPI. And we had a pretty large gap in the chart there in the 12,082 level to up to 12,268. And so at the midpoint of that range, these two blue lines is where the Nasdaq 100 has topped out. In saying that, when we made the year-to-date low back in mid-June, the ensuing lows have been higher lows. So we're in this period of uncertainty here where we have some high lows going into a clearly defined resistance range. Again, this is very short term. So even if we do have a break of this pattern, either to the upside or the downside, it still remains to be seen what the longer term trends or resistance level, support levels will be. We can see right here, this is the daily period chart. Just zooms in a little bit more. Zooms out a little bit more, takes out some of that noise and looks back a little further. And you can see that longer term downtrend is still in place. We have this extended period of consolidation, probably the most we've seen since the month of March. And so, we do have a lot of catalysts coming out, and we'll see, maybe earnings will be the driver as to how we break out from here.
Yeah, and let's take a look at the yield curve as well. I mean, certainly rates have been reacting to what we saw at CPI, PPI, of course, anything that the Fed does. And those moves for a fixed income market have been, they're pretty extreme. You don't typically see that type of velocity historically.
Yeah, absolutely. So here we have the chart of the spread. We have the 2-year versus the 10-year, the 10s and 2s, and we can see that in the last week or so, we've gone negative. And we were negative for a brief moment there in late March, early April, only for maybe 2 trading sessions. And now we're much deeper, about 18 basis points negative. We were about 25 basis points negative yesterday. So if you look all the way back, going back to about 2000, or let's say the depths of the global financial crisis going into it, which is in 2006, this was about as negative as the yield curve went, the 10s-2 spread. Although the negative yield curve is often a indicator of an oncoming recession, it's when the curve reverts positive to when recession historically sets in. What's different this time, though, is the reason why historically that curve goes positive is because the Fed sees concerns in the marketplace and the economy and begins to cut rates dramatically. And that's what re-steepens the curve. This time around, it seems the Fed is looking to, slow down the economy, to slow down the demand side, to lower inflation. And so I don't think we're going to see this time around the curve re-steepen as quickly as we say normally would at this point in the business cycle. So we've seen commodity prices recently coming down sharply, copper's falling, oil's falling. So those could be market signals. Break evens are falling as well. Those could be market signals that the Fed possibly would key off of historically and begin cutting rates. But this time we're 2 weeks away from what the market's looking for is a 100 basis point increase. We saw last month when the Bank of England raised their rates, they actually lowered their economic forecast for the year to negative territory. So these are certainly different times. And so while we like to look at the past to see if history will repeat or rhyme, we do have to keep in mind that certain things do change in different cycles, and inflation is a big difference in this cycle than what we've seen recently.
Yeah, and Brian, I want to wrap up here and take a look at the U.S. dollar. It's certainly clearly at the top right of the chart versus yen and the euro. And I guess really it's in the ECB's court, right? So until they do anything definitive in terms of raising rates with no conditions attached, right, this trend with the dollar to the upside seems as if it's pretty much so intact.
Yeah, this trend has been phenomenal. This here's a monthly period chart, so each of these candlesticks is 1 month, and so you could see, a dramatic rise um, in the U.S. dollar since July of last year. For about the last 12 months, we've broken above resistance levels from 2015 and 2018. About 50-60% of this index is the dollar versus the euro, and if we look at that currency pair, we can see that just broke down below the 7-year support level this month. The other biggest pair in that index is the dollar yen, and we can see that pair. This is actually a quarterly period chart. Had a major breakout. I'm sorry, this is monthly. Had a big breakout in April of this year, and we're looking at a resistance level that goes back to 2007. So this is a 15-year resistance level, and we can see what appears to be, in my eyes, a somewhat of a bottoming pattern in inverse head and shoulders. If that's the case, then I would certainly be concerned. If the risk here is that this is a breakout from such a major pattern that this could be a very strong multi-year trend leading to extreme Japanese weakness.
Right, and Brian, just to wrap up here, because if earnings season is anything indicative of how it's opened up, the rise of the dollar is certainly going to impact your global conglomerates. These massive conglomerates that we have. It's going to put pressure.
Yeah, so we will definitely hear commentary on that, and that is absolutely one of the big topics that the investment community is looking for. I think the S&P 500 companies, 30% on average of them, 30% of their exposure is to overseas. So a stronger dollar will negatively impact those overseas earnings, and so certainly a big topic that we'll be looking out for.
All right, appreciate the insight as always, Brian. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.